Good morning again, everyone. Thank you for your patience. I want to take this opportunity to welcome you all to SYGNUS Real Estate Finance Limited's earnings call for the financial year ended August 31, 2024. I am Justine Powell. I'm a part of the investment management team at SYGNUS Capital, and I'm pleased to be a moderator for today's session. For additional clarity, SYGNUS Capital is the investment manager for SYGNUS Real Estate Finance Limited. We do appreciate you taking the time to join us to discuss SRF's performance for the year and to learn more about our operations as well as our future plans. I also want to remind everyone that today's discussion may include forward-looking statements that could result in actual outcomes in the future differing from our expectations. We encourage you, as usual, to review the audited financial statements as well as the management discussion and analysis that have been released. And these are located on the Jamaica Stock Exchange website, and they will also be added to the investor relations section of SYGNUS Group's website. Now, I want to take the opportunity to introduce our speakers or presenters for today. So we have Mr. Jason Morris, Chief Investment Officer and Executive Vice President of SYGNUS Capital. And we also have Mr. David Cummings, Vice President and Head of Real Estate and Project Finance at SYGNUS Capital. After Jason's remarks, we will open the floor for questions, and we do encourage everyone to participate by submitting the questions through the Q&A feature in the Teams platform or via email at srf@sygnusgroup.com. So at this time, I will hand over to Jason to start the presentation.
Hi, good morning, everyone. Hope you all had a fabulous week so far. Welcome to earnings call for the financial year ended August 2024 for SRF. I want to just start out by saying, I want to really appreciate shareholders for being very patient with SRF, which is a real estate investment company with a twist. It's pretty nuanced. I mean, when we go through each quarter, the report, the year-end financials normally look a lot different from what the quarterly typically looks like, and this year is no different. So I just want to start out by reinforcing that. Now, in terms of the backdrop for SRF and the major achievements that we have generated for the firm, which, this is its 5th year of operations. So it's a pretty good marker. You could say end of one investment life cycle, so to speak. So there are 6 key things that we want to kind of highlight before going into the actual meat of the financial performance. The first one, of course, is that over the last 5 years, if you average the return on equity that SRF has generated, that's a pretty decent return by any stretch of the imagination at 19.1%. And I want to always, presence for shareholders and prospective shareholders that the way that SRF operates as a company that is seeking to unlock value in real estate, in many instances, the value will be unlocked, but the cash will come later, right? So I just want to present that. And again, looking at the performance of what we have done, or what the company has done since inception to try and unlock value from real estate, take those monies, redeploy them, unlock value again, and eventually get to a stage where we can start to pay dividends, which I'll discuss on later. So pretty decent return, 19.1% return on equity. I think that's an enviable track record in terms of overall returns generated thus far. Second thing we want to do, and this is more on the financial year, but beyond the financial year as well, is the flagship project that has been under execution over those 5 years, and especially within the last financial year. It will be One Belmont. And I know that David will later give us some updates on this, but to present this to say that, you know, this is a very substantial transaction. I think everybody can see the building, right? And I think David will tell us if the building has won any awards or whether or not the people associated with the building has won any awards for the architectural design, etc. Later on, I'll leave that to him. But project execution has gone substantially very, very, very well. Excellent execution. And you know, the execution that's happening here is multi-purpose. One is obviously the building, but the other one is also executing an interior build-outs for tenants who have signed the lease agreements. And of course, speaking of lease agreements, moving lease agreements from agreements to lease to actually firm contracts that have been signed and executed, which would have occurred during the financial year. So I want to again big up the One Bellman team, Peter Gay, David, Conceptor Ike, Dr. Ike Johnson, for a phenomenal job to bring this idea that was something on paper to reality. In terms of, you know, winding down the investment life cycle, 2.3 billion in investment exits would have occurred, which is something that would have presented at the last annual general meeting, that something that we were seeking to do to kind of reorganize or optimize the portfolio mix. And we would have had a large portion, well, a portion of this 2.3 billion would have occurred during the financial year, and transactions that started execution during the financial year would have concluded post the financial year. So all in all, you know, we have stuck to our guns, and, well, let me not use that term. We have stuck to the task at hand and delivered what we promised that we would do in terms of optimizing the portfolio mix, and we continue to do so as we go through time. Capital, as we wound down the first investment life cycle and starting the second life cycle, obviously, you know, we're going to use proceeds from first investment life cycle to reinvest in the second. But we also indicated that we would have needed to raise new capital to get the second life cycle well and truly underway. And we had indicated that what we wanted to do was to deploy a substantial amount of capital into income generating assets in this second life cycle. And obviously what we'll also do is, as One Belmont wind off the books at the appropriate time, is put other assets on the book to replace One Belmont in an inverted quotation, right? Because we need to repeat the process of investment continuously. So I'm happy to say that SRF would have raised a record. I think this is the largest capital ever raised by the company, which totaled approximately 4.1 billion when you take the 15 million US plus the Jamaican equivalent. 3.38 billion of that would have been raised as at the end of the financial year, or during the financial year, and the remainder would have come into the coffers subsequent to the end of the financial year. Fifth thing I want to focus on is book value. I know that at the last AGM would have focused on the price of the stock, and why at that time the stock price was trading at like 60% of the book value, and the book value then was lower than it is today, meaning the book value today has gone up from when we were speaking. So $24.90, J, book value per share, which is again another credible performance in terms of the value that we are carrying on the balance sheet. So we continue to push very hard and say to prospective shareholders and for existing shareholders who have been very patient, as everyone get used to this kind of different type of business model, so to speak, that we are pursuing, that we continue to unlock value, and that value is reflected in the assets on the balance sheet. And $24.90, 24.9, and $24.98 is reflective of what the company is doing. And of course, you all know that we are transitioning between investment life cycles. So by and large, we don't have a lot of sexy things to talk about. in terms of projects, etc. But in short order, we will be able to do so as we, transition between the two life cycles. And just to highlight the fact that this transitional period, the investment manager would have, of course, reduce its management fees to align temporarily with the life cycle shift. You can go to the next slide, Steve. So that's the backdrop. Now into the performance. I'm happy to report that SRF would have generated a 49% increase in net profit, amounting to 315.08 million. And total investment income would have come out 9.6% higher at 839.24 million, with net investment income of 508.5 million, up 62.7%. EPS 0.96 Jamaican dollars or 96 Jamaican cents. And I spoke about the book value per share already. Now, what are the main drivers of this? So over the next two slides, I want to give some context to this. So, the primary driver of the increased total investment income or top line revenue, which would have obviously driven a net profit, were two main things, right? The first is share of gain on joint ventures, which increased by 45.1% to 493.49 million. And as we keep saying, and this is obviously reflective of the value in one Belmont, which is reflective of the lease agreements that would have been signed, one, and two, some other areas of Belmont that we are unlocking value, right? So we are seeking to, and this is not fully baked in as yet, we are seeking to obviously create additional value outside of the floors that are being leased. So for example, well, you should know already that our parking is paid parking, but as well, more importantly, the roof of one Belmont, to try and monetize the roof to enhance the value of the asset, right? And there are other areas on the property space that we are seeking to extract value from, and we'll continue to work towards those. So as of the end of the financial year, this gain that you're seeing is reflective primarily of the lease agreements, but as I said before, we're also seeking to create additional value from other areas of the building, which will bring recurring income and therefore enhance the valuation. So that's the first thing I want to highlight. The second thing, obviously, because we hold a substantial amount of investment property, and these properties are actually USD assets, then each year when we do evaluation, which is only done at the end of the financial year, then we expect that the value of these assets will go up, which is what you see here, up 21.6% or 524.13 million. I have to say though, and this is a point that I want to, some people may have it, I'm not sure, but just to bring it to the fore, that obviously the quarterly financials does not reflect in large part substantial movement in the two main drivers that we're looking at, just because that just based on the nature of SRF's business model. Of course, we are trying to see if there's a way to get some of these drivers in the quarterly financials, but I don't think well, accounting rules are constraints to that, right? But needless to say that so far over 5 years, we have consistently explained the quarterly financials to shareholders, which in many instances has less than desirable financial reporting because of the nature of our business model, which requires valuation once per year, which is at the end of the financial year. So I just want to bring this forward again, because I know that each quarter when people look at the quarterly financial statements, and when you're looking at the end of the financial year, you may be saying to yourself, why is there this big jump versus, for example, the 9-month results? And that's just the nature of the beast that we're dealing with. On the next slide, I want to quickly just break down to show you a few items. So if you look at interest income, it would have declined 180 million versus 253 million last year. And the reason for this, we would have highlighted and all three earnings call during the year in the interim quarter report that we would have been exiting REINs that had high interest income. And as you exit those REINs, right, your interest income is going to fall. We are redeploying capital into new REINs, which will ramp up substantially, are starting to ramp up substantially from the quarter that we are in now, right? Obviously, the deployment into REINs, normally you don't deploy all the money at once. So when you exit and then you need to invest, the investment cycle takes a little while. It might take, I don't know, 12 months, 15 months for the REIN to draw down on the full amount of the commitment, which means that you've got a gradual build up in interest income over time. So as you go through the quarters in the upcoming financial year that we are in now, 2024-25, you'll see interest income. You have that flux between rolling off existing REINs and putting on new REINs, right? Other item I want to highlight is the loss on sale of real estate asset, which would have explained during, I think, Q3 and Q2, or Q3 rather, which is primarily reflective of the exit SRF from one of the assets that we would have developed, which is Spanish Penwood, that's the Inca headquarters. So one of the investors, so we basically completed the project and exited it at the price that would have been pre-agreed, right? And that would have resulted in that 43 million loss. However, on the flip side, SRF is currently in a gain position because we would have obviously structured a different type of investment, lease investment, right? Where we would then would have bought that asset at a discount to its value, and we would have also been earning and continue to earn the lease income from that asset. So if you add up the lease income from the asset plus the gain that we get from buying that, or I should say investing in that asset at a lower than market price, or lower than the valuation price, then we have made back that gain. But that gain is not reflected in a separate line item by itself. It's rolled up in the overall gain on investment property. So I hope I'm not confusing anyone. So this, we have to break this out because the asset was listed for sale and we sold the position, book that loss, and then we structure a different note that we invest in that note and basically partially offset that loss. Plus, when you add the lease payment that we get, we would have been earning and continue to earn. We have wiped out what that loss is, but you're not seeing it in a separate line item by itself because it's rolled up in the gain on investment property. So I want to highlight that in case people are asking that question. Operating expenses obviously is down 330 million, but 330.7 million versus 452 million. Again, the primary driver of this is because of the temporary reduction in management fees from 2%, which is where it's normally charged, to 1% for the 2024 financial year. And just for edification of everyone, for the next financial year, which is started September 1st, that management fee will be 1.25%. Again, so it's going to be still discounted from 2%, but it will step up a little bit to 1.25%, which is what we had indicated last year, that there will be 2-year temporary reduction in management fee, first to 1% and then to 1.25% as we go through the transitional period. So just want to highlight that. And of course, lastly, net foreign exchange loss, which would have been 93.6 million versus 81.7 million last year. Again, I want to preface this that this FX loss, which is unrealized, is driven by the USD liabilities and SR balance sheet. And this is a kind of another accounting, what should I say, right sizing again, right? Because the financial assets on the balance sheet, such as debt, are fair valued, right? They are marked to market on a monthly basis. But on the asset side of the balance sheet, right, because SRF is a real estate investment company, on the asset side of the balance sheet, SRF is not going to have a lot of financial assets that you mark to market the FX portion of it. What SRF is going to has is a lot of real estate assets, and real estate assets are not classified as financial assets. So all the real estate that we have on the balance sheet, which are USD denominated, if you were to look at the gain, right, on investment property of 534 million, if you were to extricate from it how much of it is due to FX, because you have a US dollar property and the exchange rate move and you're valuing that US dollar property 1 year later after the exchange rate has depreciated, and clearly part of the movement in the value is going to be some FX in there, but you don't break, the valuator is not going to break it out. So I'm saying that to say that you have to interpret the net foreign exchange loss within that by looking through that lens. That being said, obviously we are taking measures to reduce our net USD liabilities, but one of the USD liabilities, for example, is tied to a USD vendor mortgage that we have on one of our largest USD properties. Obviously, the vendor is not going to give you a J dollar mortgage for its US dollar asset, right? So there are these nuances that SRF has that are just anyone who may not be clear upon this. I want to ensure that you can follow what's really happening, right? Okay, so I'll go a bit faster to the remainder of the slides, because I think those two slides were very important. So on this slide, we are doing as we promised, which is to keep management expense ratio very low. 2.1% is our conventional threshold of 3.5%, and that threshold, by the way, is a benchmark against international best practice. Efficiency ratio 39.4% versus 45%, again within the threshold, so nothing more to say there. So in other words, every dollar of profit that we are generating, our revenue, it is being efficiently utilized in terms of the expenses that are coming out of it. Next slide. So now I will speak to investment activity, and of course the background to this is that we are transitioning between investment life cycles. So what you are seeing here are basically transition numbers. So real estate investment assets would have declined to 14.7 billion from 14.92, and that 40.7 billion is made up of 9.26 billion in total property investments, right? And of course, that was lower than the 10.44 billion last year, driven by the fact that we would have exited a number of investment properties during the financial year. And post the financial year, you're going to see similar things. Well, let me not say that too quickly. And we, of course, we would have been exiting. We're going to continue to exit. We would have had on the books available for sale assets, which the sale would have concluded post the end of the financial year. But those sales, but that reduction, obviously, as we go through time, can obviously be impacted by any asset that we acquire, right? So it's not necessarily that total property investments will necessarily decline. We're in transition periods. I'm just trying to set the table for you that the figure has been coming down because we have exited some assets, but exiting of assets in the new financial year could also coincide with new assets that are added to the balance sheet. So it depends on how, on the timing of those and which quarter these things happen. The real estate investment notes would have increased to 2.29 billion, right, from 1.83 billion, consistent with our mandate to say we're going to increase investment in income generating assets to optimize the asset mix at the balance sheet. So that's consistent with that. Joint ventures would have gone up to 2.03 billion, again consistent with the movement in the value, primarily driven by One Belmont, which now has firmly signed what I'm going to term blue chip tenants with multi-year leases in hard currency or linked to hard currency. And then in terms of exits, during the financial year, we would have exited 1.09 billion, which is higher than the 875 million that we did last year. And of course, the balance sheet dry powder would have been substantially higher than it was last year at 900 0.97 million, with a small amount left in the construction loan for One Belmont of 27.4, which is an indication that One Belmont is pretty much done and dusted in terms of completion. Next. Investment allocation. Not gonna say much here other than if you look at the slide on the right side, the right chart, which is showing investment property at 70.6%. So still you can see that we have a lot of undeveloped assets on the balance sheet. And as you are now very well aware, right, if we think it makes sense for shareholders, we'll optimize the return on assets by simply, for example, selling the asset to somebody who wants to buy it from us at a reasonable price, and we make a return on the asset. So I'm trying to present everyone to say, okay, the assets that we will obviously develop ourselves, create pretty buildings that will last a lifetime and extract substantial value from that. And there are assets that we will have where if we think that the best way to optimize or unlock value from that asset is to hand it over to someone else who is going to pay us a fair price for it, then we will do that. So there's nothing that precludes us from doing this. So I just want people to understand what we are in the business of doing, unlocking value. And sometimes it's good to buy an asset, sit on the asset, the value goes up and then you sell it to somebody else. And that may be the best thing to do with that asset, right? So we are fully locked in on unlocking value by any means necessary. Next. So now I will preface this and then I'll let David jump in. So just an update on our asset holdings, right? And as you can see, with Charlie Mean Holdings, which held Hillcrest, or is holding Hillcrest, you can see that that asset was classified as an asset held for sale, which means that we are exiting the asset, right? 56 Lady Musgrave Road would have exited that within the year. 58 would have exited that, and it would have spoken about these two and prior earnings calls. I'm not going to go through them again. We made some decent returns there relative to the initial purchase price. I think we would have made substantial double-digit return on those assets on a gross level. Spanish Penwood, we spoke about this on prior earnings call as well. So we would have exited the asset 100%, and then we kind of structured income generating asset for us to then participate in the cash flows and in the ongoing cash flow of the lease income that is generated. And so, you know, those are four assets that if you look at them, we on a go forward basis, they won't be part of this slide anymore, because we have done our job in terms of optimizing the value the best way we saw fit and exit them. So on the next slide, our next set of slides, I will allow David to give us an update on what's happening with some of the key strategic assets that we would have shown on the previous slide.
Thanks, Jason, and good morning, everyone. First of all, One Belmont, as you would have heard Jason indicate, recent award that this building earned in September in London at the International Property Awards. The One Belmont architects won the design for the best office development in the region. So certainly kudos to our design team, and the proud thing here is that it was a Jamaican architect who designed this. So One Belmont won the design award for the best office development. And of course, the architects is Virtuoso Architects. So it's 99% complete. You may ask yourself, what is the remaining 1% that we have? and that is some of the cosmetic things like landscaping. If you have driven past the building in the last 2 or 3 days, you would have seen all of the plants and the greenery is being installed now. So just to give you some color as to what is the remaining 1% that we have left, it's just some cosmetic things such as landscaping, which is currently in progress. The tenants are currently executing on their interior design and build out. So you'll gradually have tenants moving in, in the months ahead. Of course, it's a marquee commercial property on Belmont Road, and of course, we are confident that we have delivered on what we set out to achieve. I think the award that we won in London, or that the building won in London in September, is testament to that. And of course, in the picture here, you can see that the LEDs were pink, and this is again one of the intentions of the design, to be able to showcase or celebrate certain moments. And we had the building lit pink in the nights during the month of October in honor and celebration of Breast Cancer Month. So that's it for One Belmont. Next slide, please. Miami Bay, we have received the additional studies that we had alluded to. So we continue to make very good progress towards a decision phase with this particular property. And once we get to that milestone, of course, we'll be able to update you on how we will be unlocking the value of this magnificent beachfront property here. Next slide. Lake Spen. So we made actually very good progress in our plan to unlock the value of this 55-acre industrial property right out there. It's sandwiched between the East-West Highway and the Lake Spen Road. That's the area in blue you see on the screen. Directly opposite what that white building, the roof building, is actually Wisynco. And once we get to that milestone, which will be very shortly, again, we will revert and give you an update as to exactly the path that we have selected to unlock the value of this 55-acre park. Next slide is Hillcrest. I don't need to expand on what Jason has already indicated in terms of this particular property here, the 3.2 acres on Hillcrest Avenue. So the next slide is 26 Seaview, half-acre property here, but you can see on screen at the corner of Montrose Road and Seaview. We are still considering and evaluating all the options we have to enhance the value of this property here. As you can see on screen, we remain on track to have this asset monetized during 2025. And likewise for the next slide, similarly for 16 Montrose on the next slide, again, we are continuing to consider and evaluate all our options to enhance and unlock the value of this 1-acre property here, which is along, as you can see, on Montrose Road. So that's the update for the projects. Of course, Spanish Penwood, Jason already alluded to that. We have already exited this particular asset. So I don't need to go into any more details. And you can, those of you who drive past on Spanish Road, just at the intersection of Penwood Road at Chesterfield Avenue, after you pass Toyota Jamaica, for those heading in a westerly direction, you'll see it on the right-hand side, a beautiful building, and it's now currently in full operation. So that, I believe, completes the project updates. I'll now hand back to Jason.
Thanks, David. So just to give some insight on, well, where is SRF headed, right? And we are being very transparent in giving shareholders and prospective shareholders bird's eye view of what we are doing with the firm, and what the firm is trying to achieve and what its long-term goals and objectives are. So there are 3 key pillars of this strategy, and the first one, and is always going to be number 1, right? And that is to execute the key strategic initiatives. One Belmont was and is a key strategic initiative, and that's pretty much in terms of the economics of the One Belmont project. The value creation process, you could say it's completed, right? And what we are structuring now is the exit part of the value creation, because you can create value, but if you can't crystallize it, then you have optimized the investment. So what we are doing now is working on the exit, and that is progressing according to schedule. Right, we have the occupancy, we have the type of tenants that we wanted to be in this building, which again, kudos to David, Peter, the real estate team, for negotiating some very top tier tenants in the building, which at the appropriate time we'll do that review. So that's going very well. Miami Bay and Lake Spen. So that was our investment life cycle 1 strategic initiatives, which we could say it's for the most part done. Now Miami Bay and Lake Spen, which is second investment life cycle, and David would have highlighted how we are progressing on those. So it's to get those, continue executing them in a timely manner, to have them now front and center as the 2 flagship projects, given that one Belmont is gonna be more of a rear view mirror transaction. So Miami and Lake Spen executing those, and we continue on the execution of those. We have also said that we wanted to, we're not just acquiring assets and figuring out how to unlock value in them. We want to be what I'm gonna call additive to the real estate investment landscape in Jamaica and later on the wider Caribbean. So to do that, we have to be able to provide financing, provide our expertise, right, and partnership with the real estate industry and sector. So people who have land and they don't know what to do with the land, we are here to say, hey, we can provide financing, or we can figure out the best thing to do with the land and provide financing, or we can simply execute an idea that you have that you're going to provide financing for. So whatever it is, once it is called real estate, we want to deepen access to those who need capital plus solutions in this space. So that means we have done and will continue to do a lot of joint ventures, and we have quite a number that we're working on. We have new joint ventures that we are executing as we speak. There will be co-developments where we become a development partner with other persons in the space, and we are working on those as we speak. And of course, the REINs, real estate investment notes, which I don't want to call it an invention, which is a structure that is being utilized to provide capital to people who know what they want to do already. They have their development plans, etc., but they have a gap in financing, right? So the bank might be willing to lend them some money, and they have a gap, or maybe the bank is not willing to lend them any money, and so they have a really big gap, and we can provide financing there as well. So I just want to say that we are working on all 3 of these joint ventures, co-developments, and real estate investment notes in terms of trying to deepen access to capital to the sector that we are playing in, and that's very important to SRF. Then we spoke about the portfolio realignment, which is going on, and you can see the exit that we have done. I simply say, okay, let's rebalance the portfolio. Maybe this asset, based on what we can do with it, maybe other people can figure out better, or for us, based on where we are maybe over invested in a particular type of asset, and we want to perhaps take on a different type of asset. And when we look at the cost benefit analysis, it may be better to exit asset A and take some of the proceeds of asset A and go and acquire or invest in asset B, because the economics are better. And that's what everybody, as an investor, that's what you do all day, every day. That's what we are doing. The only difference that we are doing in real estate, right? And of course, key part of this is ramping up the income generating side so that we can reduce the quarterly issue that we have, where when you look at the quarterly financials, it's showing you negative, which is not a true reflection of what the actual audited financial has been or is or will be. And finally, of course, managing the investment lifecycle overlap. So we have been very deliberate here, and that's the reason why we went all the way out and explained to persons why we would have reduced the management fee, which is not something that I guess the Jamaican investment market is used to. I'm not sure, which managers actually reduce their management fee. Whether things are going good or bad, management fee remains the same. And I think that this is just an example of us really and truly benchmarking ourselves against best practice internationally. So that's the first thing to execute key strategy initiatives. The second thing, of course, to aid in that is dry powder. So you have to harvest and redeploy capital. And as part of that as well, you have to raise new capital, which we already spoke about. Maybe one thing that's not here is the fact that we would have, and the third thing, right, obviously is dividend, which I know everybody wants to know about. I think that I think there was a notice that went up to the stock exchange yesterday or day before yesterday about the fact that the board will be meeting to consider what would be, I guess, if the board finds favor and if it's approved, it would be the first dividend that SRF would be paying. And again, I want to highlight the fact to people that when you look at SRF financials and how SRF operates, it's going to unlock the value. In many instances, unlocks the value up front, right? But you get the cash at the back end. So, for example, if you buy an asset today, a property today, and you were able to negotiate with the vendor to give you a vendor mortgage, for example, and to negotiate a purchase price, that's a massive discount to what you know that in 2 years' time you could sell it back for, and then that 2-year period comes and you're selling it, right? At the time when you're selling it, you could actually, for example, book a loss in that financial year, because if in the first year when you bought it, obviously you have to book the gain when you just bought it based on what you bought it for versus the valuation, right? But if in the year when you're selling it, let's say the value does move and you take all the costs involved in sales, then you could end up showing, like, for example, a small loss on your income statement just for that financial year. But on an overall basis, you might have made 20-30% return, 40% return on the asset because you bought it for $1 and you're selling it for $1.40. But if the previous financial year you were carrying it at $141, and then this year you have to carry it at $140, then obviously you book a loss. So I'm just trying to explain to you that in many instances, given the nature of SRF's operations, you can have those type of things happening. But we are at the stage where one could say that our first investment life cycle has concluded. I mean, there are still remnants and overlap that's going to happen in this 24-25 financial year, but the first life cycle is done, and that's the reason why we are at a stage where we need to now evaluate and consider a dividend distribution, which obviously I think next week when that happens, the results of that will be released to everyone. Final point I want to highlight as well, because it would be remiss of me to not do so, that obviously as we execute on this strategy, there are going to be assets, and there are assets that we will have from time to time that didn't go according to plan, right? And you have to put those assets into receivership, for example, in order to scope our investments. And we do have 2 assets like that on the balance sheet that we are managing through that process. So, you know, that process is continuing. And of course, as usual, you know, we are whenever we have anything to report, and that we will report to you as we always do. So yeah, that's the full summary, high level summary of this earnings call, and we're now open to take questions.
Thank you so much, Jason and David, for providing those insights into the performance of SRF. So at this time, we will segue into the question and answer segment of the session. I'll start off with a question that we have from a viewer on YouTube. Have the PIC shares been issued? So I will hand this one to Jason.
Good question. So we're still working with the stock exchange to execute that. I think the stock exchange is having a little bit of difficulty with completing that, but progress is being made. It's not every day that the stock exchange has to deal with PIC shares, right? So it's a bit of a novelty, but we are working with the stock exchange to get that done and dusted in the shortest possible time.
Thank you, Jason. So the next question, any details on the new investment notes to be reinvested in? Is SRF bullish on any particular sector?
Well, let me take the first part and try to start at the second, and if David wants to jump in. So in terms of real estate investment notes that we are earmarking, the good answer or the good news is that we already have approval for, I don't know, 10, we have, I would say maybe $2 billion worth of approvals. Actually, it's more than that, right? North of $2 billion of approvals sitting and waiting on the drawdown and the process for those projects to make their first drawdown on the capital. So the answer is those were when the committee went through a long due diligence process. Due diligence process completed, documentation, some documentation still outstanding for first draw to be made, but I expect deploy investments to be made in the quarter that we are in now, to see some of those come on the books and continuously for the remainder of the financial year, and probably that value gets up to, should be north of $2 billion easily. And the second part of the question, are we bullish on any particular sector? David, maybe you want to take that.
Sure, thanks, Jason. Yes, we are. Of course, the 4 segments, I'll touch on them briefly. Industrial, we are bullish on it. Not just because we have our own 55-acre project coming in that particular segment, but because, as you may or may not be aware, there hasn't really been much renewal of our industrial stock in recent times. So we're finding there is a significant demand for industrial renewal, and of course that's why we're launching our particular project. So we're bullish on industrial. The housing side, also on the residential side, it varies by market. Obviously, the low-income side of the market, there's untapped. I mean, there's the demand there, as you will be aware. We've never really been able to fulfill the demand there. Hence, all of the NHT programs in that sector. So, low-income housing, there's a huge demand there. Middle range and the upper end are those that are we are. Clearly have a few projects that we're looking at there, but you have to be very strategic with how you do projects in those sectors. What is doing very well, of course, is on the North Coast, where there's a high demand for beachfront, sea view, and so on. So there's high demand there. So we are bullish on sort of North Coast residential. On the commercial side, there is, as you will be aware, over 500,000 square feet coming to market in the next sort of 12 to 18 months, including our own project. So there's a lot of renewal that's taking place there. What will be interesting to see is how the market will respond to what is sort of a migrationary effect, because a lot of the businesses are moving from old buildings into these new office buildings, and it will present an opportunity for how we sort of repurpose or renew some of the older commercial stock, particularly here in Kingston. And of course, the last segment is hospitality. And as I'm sure you will all be aware, Jamaica's hospitality is back to and surpassed pre-COVID levels. And there's quite a few large hotel developments taking place. So of course, the outlook on the hospitality side is also bullish.
Thank you so much for that, Jason and David. So the next question is in relation to One Belmont. Will One Belmont become a lease participation investment like Spanish Penwood?
How should I answer that question? Absolutely. We wouldn't be good stewards of shareholders' capital if we didn't. I'm going to choose my words carefully. If we didn't try to maintain a stake in whatever structure that we're going to utilize to exit from the asset, right? For SRF to have an exposure and maintain an exposure, simply because of the nature, primarily because of the nature of the tenants that are in the building. One, and two, the nature of those contracts, which are in some instances are they're long-term leases. So it would be remiss of us not to enhance SRF's income generating capacity to ensure that SRF maintains a stake in whatever way, shape, or form that is. So the answer to the question, whether it's gonna be an LPI or not, that still remains to be seen, right? Whatever the structure is, can be working through that as we speak. But if you are asking, are we going to maintain, have SRF quote unquote invest in whatever lease flows are coming from One Belmont when that structure is complete? The answer is yes.
Thanks for that, Jason. All right, so we have another question coming in from the Teams Q&A segment of the platform. This one is in relation to Ocean's Edge. They noticed a recent ad in the print and they wanted an update on this particular investment note, this third-party note.
So, good question. As I mentioned at the back end of my closing remarks, that we do have assets that the investment did not go according to plan, and Ocean's Edge is one of those. It's a third-party REIN, and the third party who was doing the development, the execution, hasn't gone to plan. And since we are debt investors in the project or in the asset, we had to do what we had to do in order to protect investor capital and try and recoup our investment. So it's in receivership. The receiver has been working assiduously. I think there were bids that have been received so far, so that process is ongoing and continuing. What I can say is that though this is not on us, but that those persons who would have been depositors in that development, the nature of the construct of our financing would have been to ensure that depositors' capital would have been held in escrow, and so depositors would have received back their capital, which is a construct that we always try to ensure it occurs, right? So even though it's not our responsibility, we structured our investment such that the nature of how depositors' capital was used, it was protected. So they have gotten back, those depositors have gotten back their deposits. So that part is not an issue. But in terms of the work that the receiver is doing with the asset that clearly now wholly and solely is an asset that represents the collateral for SRF's investment note. That process is ongoing, and when we have something to tell you about how the receivership process is going, we will do so. But at the moment, we don't have anything to report on because that process would have just started not so long ago.
Thanks, Jason. All right, so the next question is in relation to the new capital that was raised during the period. Can you comment on the structure of the new debt and how it will impact the net interest income for SRF going forward?
It's a good question. I think we have a multi-tranche, multi-currency debt offering that we did, where some of it is J, some of it is USD. We have floating rate portion. A portion of it is floating rate. And the floating rate of it, part of it kicks in, I think, after a year. So if rates continue downwards, then we expect to see some reduction there. But by and large, because we have taken on a large amount of debt, obviously, interest expense will go up. But as I said before, we are redeploying that capital into higher interest earning investments. I think the average interest, the average yield on the asset side in terms of what we invest in right now on the balance sheet is less than 10%, right? But the new assets that we are adding are all gonna be, I think, north of 14–15%. So we expect increased interest income, while at the same time, while we have a higher debt stock and therefore higher interest expense, if interest rates continue on their path down, we expect to see savings from that after a year once the variable rate portion kicks in. And in any event, right, if rates go down substantially and on the asset side, our investments are working according to plan, we can always take the option of refinancing, for example, fixed rate debt that we would have borrowed in this capital raise, refinance it at a lower cost. So there are multiple options open to us. The important thing is to ensure that we have the dry powder on hand, ready and waiting to deploy, and we actually manage that dry powder. So what we do is, okay, we don't just raise capital and have it on the balance sheet. We pay out other debts and then have the capacity to draw back on those debts that we paid out, like revolving lines, etc. Right? Keep those as rainy day, and so we can draw back on those to ramp up deployment into new assets, as the case may be. And as I said before, we can always refinance. And we actually invest those dry powder that we have on the balance sheet where we have to keep it at pretty decent rates, right? We negotiate very hard with our investment brokers to have those assets invested at pretty decent rates. And so if you look at the rate that we invest the cash at and our borrowing costs, what that does, it reduce the negative carry or the negative margin that exists during the temporary period when you are waiting for the project to actually draw down on the dry powder.
Thanks, Jason. All right, so we have one final question. This one is in relation to Lakespen. When is Lakespen expected to break ground? So I will hand this one to David.
Sure. So the process for us to break ground involves the design phase, which is what will take place over about 5 months. And once we press the go button, and then once we have done the designs, we then have to go through the approvals with the St. Catherine Parish Council and NEPA, etc., on regulatory authorities. And that, as you can appreciate, is can take anywhere from 4 to 7 months, depending on the speed at which we're able to get it through the regulatory processes. So quite likely groundbreaking will be at the start of, at the end of the design and approval process. So about a year from when we press the go button. So quite likely it's probably going to be about a year or thereabouts from now before we actually break ground, once we have made that final decision and press the go button.
Thank you, David. All right, so we are now at the end of our session today. I want to thank everyone for joining us. We do appreciate you taking an interest in SRF's performance and also the time that you've taken to learn about those that performance, as well as the insights and outlook for the company. As we look ahead, we're focused on being innovative and enhancing the performance of the business. Of course, if your question wasn't answered or you weren't in a position to send in a question, because we did address all questions today, we encourage you to send us an email, srf@sygnusgroup.com. In addition to that, the audited financial statements, as well as the management discussion and analysis, and also a recording of this earnings call will be available on our website. You should see it in about 24 to 48 hours. So feel free to go back, rewatch, revisit, and you can always reach out to us if you have any additional questions. So again, thank you for joining and have an excellent weekend.